Assalamu alaikum, and welcome to Learning Bites. Makamovi. Imagine you run a small business. Every day, customers visit your shop. You sell products. You pay rent. You pay employee salaries. You pay electricity bills. You purchase inventory. At the end of the year, you hope to make a profit. But what if the government asks you to pay tax based on your total sales, regardless of whether you made a profit? Sound surprising? Well, this is exactly what turnover tax is all about. Many business owners understand income tax, but turnover tax often creates confusion. Today, we will simplify this important taxation concept. In this video, you will learn what turnover tax is, how it works, how it differs from income tax, how it is calculated, its advantages and disadvantages, the challenges businesses face, and practical tips for compliance. So let's get started. Chapter 1. What is turnover tax? Let's begin with the basics. Turnover tax is a tax imposed on the total sales revenue of a business. In other words, the tax is based on turnover, not profit. This is very important to understand. Suppose your business sells products worth 10 million taka during the year. Your total business expenses are 9,500,000 taka. That means your actual profit is only 500,000 taka. However, under a turnover-based taxation system, the tax may be calculated on the total sales of 10 million taka, not on the profit. Unlike income tax, turnover tax does not focus on how much money you earn after deducting expenses. Instead, it focuses on the total revenue generated from sales. Simply put, income tax is based on profit. Turnover tax is based on sales. Chapter 2. What is turnover? Before understanding turnover tax, we must understand the meaning of turnover. Turnover refers to the total value of goods sold or services provided during a specific period. Let's take a simple example. In January, your sales are 500,000 taka. In February, your sales are 600,000 taka. In March, your sales are 700,000 taka. Your total turnover for these 3 months is 1,800,000 taka. Notice something important. Turnover is not profit. Many business owners mistakenly use these terms interchangeably. Profit is what remains after deducting expenses. Turnover is simply your total sales revenue. Chapter 3. Why do governments use turnover tax? You may be wondering, why does the government impose turnover tax? The answer is simplicity. In many cases, verifying actual business profits can be difficult. Some businesses maintain incomplete records. Some fail to record expenses properly. Others may intentionally underreport profits. As a result, determining taxable income becomes challenging. Turnover tax provides a straightforward solution. Instead of analyzing complex profit calculations, tax authorities can focus on sales figures. This helps improve transparency, reduce tax evasion, and simplify tax administration. For governments, it means more efficient revenue collection. For many small businesses, it also means fewer accounting complications. Chapter 4. Turnover tax versus income tax. Now let's compare turnover tax and income tax. Income tax is based on profit. The formula is simple. Revenue minus expenses equals profit. The higher the profit, the higher the tax liability. If profits decrease, tax liability generally decreases as well. Turnover tax works differently. It is calculated directly on total sales. Expenses do not significantly affect the calculation. Let's look at two businesses. Business A has sales of 10 million taka. Its expenses are 8 million taka. Profit equals 2 million taka. Business B also has sales of 10 million taka, but its expenses are 9.8 million taka. Profit is only 200,000 taka. Under a turnover tax system, both businesses may pay similar tax because their sales are the same, even though their profits are entirely different. This illustrates both the simplicity and the controversy of turnover taxation. Chapter 5. How is turnover tax calculated? The calculation is usually straightforward. Let's look at a practical example. Suppose a business has annual sales of 20 million taka. Assume the applicable turnover tax rate is 0.6%. The calculation would be 20 million multiplied by 0.6%. The tax payable would be 120,000 taka. Simple. No complex expense verification. No profit adjustments. No extensive tax calculations. This simplicity is one reason turnover tax is attractive from an administrative perspective. Chapter 6. Benefits of turnover tax. Turnover tax offers several advantages. First, simplicity. The calculation is easy. Businesses can quickly determine their tax liability. Second, improved compliance. Because the calculation is straightforward, businesses are less likely to make errors. Third, reduced tax evasion. Sales are often easier to track than profits. This improves transparency. Fourth, predictable government revenue. Governments can estimate tax collections more accurately. And fifth, lower administrative costs. Tax authorities spend less time auditing complicated expense records. These benefits make turnover-based taxation attractive in many situations. Chapter 7. Disadvantages of turnover tax. Despite its advantages, turnover tax is not perfect. One of the biggest criticisms is fairness. Some businesses generate high sales but very low profits. Such businesses may struggle under a turnover-based tax system. For example, wholesalers often operate on narrow profit margins. Even when profitability is low, turnover tax still applies. Another issue is taxation during losses. Imagine your business experiences a difficult year. Sales continue, but expenses increase dramatically. You may even incur a loss. Yet turnover tax may still be payable because tax is based on sales rather than profitability. This can place financial pressure on businesses. Additionally, turnover tax may increase operating costs and reduce competitiveness in certain industries. Chapter 8. Challenges in Bangladesh. Bangladesh has made significant progress in tax administration. However, challenges remain. Many small business owners lack awareness of taxation requirements. Record keeping is often inadequate. Some businesses continue to operate informally. As digital commerce grows, tax systems must adapt to new business models. Another challenge is achieving balance. The government needs revenue for national development. At the same time, businesses need a supportive environment to grow and create employment. Finding this balance remains an ongoing challenge. Chapter 9. Practical tips for business owners. So what should business owners do? First, maintain accurate sales records. Second, keep invoices and supporting documents organized. Third, understand applicable tax rules and regulations. Fourth, use accounting software whenever possible. Fifth, seek advice from qualified tax professionals. Sixth, submit tax returns on time. And finally, always report turnover accurately. Good record keeping not only supports compliance, but also improves business decision-making. Conclusion. Let's summarize today's discussion. Turnover tax is a tax calculated on total sales revenue rather than business profit. It offers simplicity, improves compliance, and helps governments collect revenue more efficiently. However, it can create challenges for businesses with low profit margins or financial difficulties. Understanding the difference between turnover and profit is essential for every entrepreneur. The more knowledgeable a business owner becomes about taxation, the better prepared they are to achieve sustainable growth. Final learning bite. Successful businesses do not grow by sales alone. They grow through financial discipline, proper record keeping, and responsible tax compliance. Call to action. If you found today's discussion helpful, please like this video. Share it with your friends, colleagues, and fellow business owners. Subscribe to Learning Bites, Makamovi, and press the notification bell so you never miss our next educational video on taxation, finance, banking, economics, and business. Thank you for watching. Assalamu alaikum. Studio microphone.